Central banks have their purchases have been continually expanding. They've gotten bigger and bigger and bigger. They know. I mean, Lucian, if you and I understand this, and a lot of people understand that the dollar's a problem, you better believe that central banks all over the world know that the dollar is a problem. They better hedge that position or put something in there or on their balance sheet that's going to expand when the dollar collapses. They're going to have to, they understand that gold is the answer to a collapsing dollar. So that's why these central banks are unloading gold. And I believe, the official statistics show that, yes, they're buying hand over fist. But I think there's a lot of unofficial buying by central banks that's not being reported. Well, I've said this for 10 or 15 years, that when all was, the end game would be inflation and deflation at the same time. Inflation of the things you need to live and survive on, and deflation of the assets you already own. And I mean, you can see the beginnings of that. Just look at the commercial real estate. That's collapsed 50% or more. And here we are, looking at credit. Look at the auto loans. I mean, auto loans are cratering. Look at home loans. Home loans, late payers. I mean, those are expanding. All the classic signs of a credit problem, they're right in front of your face. And a credit problem means forced liquidation. In other words, it means owners of assets are being forced to liquidate them. That causes a deflating price, while at the same time, your eggs, your gasoline, etc., are going up they cost more. So it's taking more dollars to sustain your lifestyle or living. Well, the way to do that is simple. If you have stocks that are core positions that you never intend to sell, then tell your broker that you want to get a certificate. And the best way to do that, the cheapest way to do that, is to tell your broker to send the shares electronically to the transfer agent. It's called DRS, direct registered the security. Once the transfer agent holds the shares, then you tell your transfer agent, I want my certificates, and they'll send you the certificate directly. That's like having a car title or a deed to a home. It's proof positive that you own those shares, because with the Great Taking, and the Great Taking is no joke, all of those laws are on the books. The ink is dry. They've been doing this since 2014, getting ready basically to bail in the public. When you deposit money at a bank, you're no longer considered a depositor. You're a lender. When you deposit shares at a broker, those are no longer your shares legally. They're the broker's shares legally for your benefit. So if your bank or your broker goes under, they're going to take your assets to try to fix their problem. So that's getting out of the system. If you have bank balances, or when people ask me how much gold or how much silver should I own, my simple answer for the last probably 4 or 5 years now is you put into gold or you put into silver whatever amount you don't want to lose, because gold and silver cannot bankrupt in a world that is going to be everything is going to bankrupt. The whole debt facade is going to come down. When one bursts, they're all going to burst pretty quickly. But, I'm on the record saying that I think the derivatives complex is going to be taken down by silver. I think silver goes and gold will go immediately. And that's going to put a very bleak picture on the other contract that COMEX has, whether it be, oil or pork bellies or interest rates or whatever. The value of a contract that cannot perform is zero. And if you've zeroed out, and I'm using silver because that is the market that I believe is going to detonate the entire system. Yeah, I don't think there's any way there'll be an outright default where there's non-payment, because they can just print the dollar. I think what to keep an eye on is we had rate cuts in 2024, but yet the rate cuts of about 1 percentage point, but market rates went up 1 percentage point, the opposite of what the Fed was trying to do. Now they just cut again last week, and the 10-year bond yield and the 30-year bond yield, they're up 10, 15 basis points higher since the cut. So what I'm getting at is, if you keep your eye on that and interest rates again move higher from here with the Fed cutting, that's telling you that the bond vigilantes are back. They just went into hibernation, and the confidence in the system is lacking. If interest rates go higher, what that says is the marketplace is saying there's more and more risk of debasing the currency, and that's how they're going to pay the debt off, is by paying with money that's half or a quarter or 10% of today's current buying power.
Yeah, Bill, how do you quantify the dollar's remaining reserve status timeline? 6 months, 2 years, 3 years, before it loses majority global trade dominance?
That's a tough one because if there's some type of an event, you may see the BRICS. The BRICS may just stand up and say, "That's it, we're done. We're not using SWIFT anymore. We're not using the dollar anymore. We're going live with our payment, trade settlement system, etc." I think it depends largely on the decisions made out of the BRIC.
Why silver over gold at the first domino?
Well, that's the silver over gold. That's easy because silver is such a small market compared to gold. I mean, the same dollar has at least 10 times more power in the silver market than the gold market because gold is so much bigger. As far as a failure to deliver goes, we're already seeing here in November, the amount standing for delivery has already increased from first notice day. In past years, if you go back 3, 4, 5 years and earlier, the first notice day would have X amount of contract, and by the time delivery was made, there might only be 10 or 20% of those contracts still standing that didn't walk away and take a fiat settlement. Over the last couple years, maybe a little more than 2 years now, what's happened is you have X amount of contracts standing for delivery, and by the time the delivery cycle is done and deliveries are being made, that number might be 1.5x or 2x, and it's already looking like November, which is traditionally an absolute non-delivery month. We may have 20, 30, 40 million ounces of silver standing for delivery. And then, of course, you've got December, which is a big delivery month. And then again, I believe February. So they're running a gauntlet right now trying to source metal to deliver to the contracts that are standing for delivery.
On the scale from 9 to 10, how would you describe the disconnect between the paper market and the physical market?
Oh, it's 100%. I mean, the big drop on Monday that we saw in both gold and silver, that was done with paper. I think the number that I heard was 1.2 billion ounces of silver traded on Monday. The world only produces 850 million ounces collectively in a full year. That's global annual production. So you had almost 1.5 times the amount of silver that's produced in a year traded in one day. I mean, I don't have, I can't show you proof that no gold or silver, physical gold or silver were sold.
Here's the irony. The same system that created infinite paper wealth is going to destroy itself because of something tangible. Silver. It's poetic justice, really. For decades, the financial elite used leverage, derivatives, and fractional reserves to control prices. They sold what didn't exist, borrowed what couldn't be paid back, and pretended that balance sheets mattered more than reality. But nature always wins. Silver is nature's kryptonite to the fiat system. You can print all the dollars you want. You can't print an ounce of silver. You can't conjure a mine into existence. You can't legislate conductivity. And when a few thousand industrial users and investors finally call the bluff and demand delivery, the entire illusion collapses. That's the domino that sets off the chain reaction. And when it happens, it'll move faster than anyone expects. Because this market, the physical silver market, is tiny. The total above-ground investment-grade silver stockpile in the world is maybe 2 billion ounces. That's it. At $50 an ounce, that's $100 billion. That's less than Apple's quarterly cash flow. Now think about this. Global derivatives are estimated at over $600 trillion. That's 6 million times the size of the physical silver market. You only need a fraction of that capital to panic into silver to blow the lid off everything. But before we get there, let's talk about what's unfolding on the ground. Central banks are openly hoarding gold. That's a symptom of the disease. They're not buying gold because they want pretty bars in their vaults. They're buying it because they know the US dollar is on its last legs as the world's reserve currency. They see de-dollarization accelerating. The BRICS settlement systems, the yuan-denominated oil trades, the gold-backed trade notes. The petrodollar is dying, and the new system is already emerging in its place. Now, what happens when the world stops settling trade in dollars? Simple. The US loses its privilege to print wealth. For decades, America exported inflation and imported goods. We printed debt, and the world accepted it. That deal is over, and when the dollar loses its status, the tidal wave comes home. Prices on everything imported, which is everything we use, will skyrocket. That's when the real inflation begins. But this won't be a gentle slide. It'll be chaotic, because while consumer prices soar, asset prices will collapse. That's the deflationary side of the storm. Stocks, bonds,